Me as a trader trading the stock market, FX or the commodities, I always love to see the charts. But it's not only guessing what the future is bringing, I love to see the probability behind that. And you might have realized that I always look at some numbers, some tables, or these red curves and areas with all the probability information. And many people are asking me, what is behind that? Can you tell me more? How do you read these numbers and all these information? I will tell you, so stick with me. Before we start with all the numbers and all the nice pictures, I have to talk a little bit about this and how we got this. This is some kind of a database. It is a while ago, to be honest. It is many years ago. We were working together with many people, and one of the main persons and the leading person behind that was Rich Swannell. He was into Elliott waves very much, and he brought together everyone to collect data, to analyze data with the computers, and to get all these numbers we are talking about in the next half an hour. So it's really, really important to mention that this guy was bringing many companies, many traders and people together, helping him to get all the numbers out of the market, because it is not possible, of course, to find it as a single person and do all the number crunching. No, it was not possible. So this is a collective information from many sites, and many computers are working on this and gave this information to this database we are talking about that today. As I know, this is not a public one, and as it's not my property, I was part of the project, so I see I can use it, and of course I can show it. There's no ban on this, but I'm not the owner of this, so I cannot give it away. But the good news is you don't need to have the exact data in all these numbers. You can have this from my videos. They are cost free anyway. You can see it here on the channel at any time. But the most important thing is to understand what is behind that. It's not the exact detail, the exact number, which is important. It is more like to understand how the market works and how probabilities in general are at the markets. If you understand that, you have everything you need. You don't need all these numbers. I'm not hiding them, but I cannot give this database into third hands because I'm not the owner. I'm really sorry about that. But yeah, so that's how it is. But I said already, this is a really important thing for me, really important as it's very nice combined with all the information we have from the chart technical analysis, in this case the Elliott waves. Many people are thinking, okay, Elliott waves, this is just a guesswork, this is just how you might see it, and many people are seeing it in a different way. And you always see it in the aftermath. You don't know how it is ahead of the time. You can only see it afterwards. And there are many myths about analyzing the markets and to understand how this works. So let us get into it and see how it works. So first of all, you can see we have a lot of different moves, different chart technical patterns. The first three are impulsive moves going into the direction of the trend. Mainly the impulses, they are very important, but we will talk about these guys here as well in maybe this video a little bit, but in the future definitely, because we have some additional information. But after these three, we have a lot of corrective patterns here. You don't need to understand exactly how this works. I don't want to dig too deep into Elliott waves now, but these are counter moves. They are going into the other direction. They are the corrective patterns. So this is important to understand, namely a zigzag, a flat, for example, some others as well. Some are more probable and some are less. But let's start with the impulsive moves, because many people are eager to trade them, of course, because they are the most nicely and smoothly moving markets. Yeah, they are the parts where you get money out of the market when you are into the right direction, of course. So this is something. It is called an impulsive move, and typically, namely in the Elliott wave analysis, you have a 5-wave move to the upside. And many people are thinking, yeah, that's really bad, because after this, I can clearly understand this, but how do I know before that this will occur? I don't know here at the very end, when the market is here, then I know, cool, it looks exactly like this. Rudy is so much right, but it's too late. I wanted to enter somewhere here at the beginning and not at the very end. Yeah, indeed, I can understand that. But if you have a closer look, you can see it's a 5-wave move. A first, a second, third, a fourth, and a fifth wave. But you also have the same idea in the smaller picture. You can have it here. It's a first to the upside, a second, a third, a fourth, and a fifth. And you can see it's exactly the same shape. Of course, in real charts, it's not 100% exactly. But with a little bit of eye training, you will see, it's roughly always the same. Indeed it is. And you can guess after this 5-wave move here, it might be very possible that something like an ABC occurs, something the same like we have this ABC here to the downside. Don't worry about the numbers and letters. Numbers are typically into the direction of trend, and letters are against them. So we call this ABC, but the upside is 1, 2, 3, 4, 5. Also on a smaller case, this is the same. And you can see, okay, this is the same here. So we have some internal patterns as well. We have a wave structure. So let's have a look at this structure as well. How does it work together? And we have something like this. It's a statistics we have found out together. And it's very important for me. Don't get this number or these numbers as a 100% exact. It is exactly this number in all cases. No, it's not. There are differences, sometimes short-term or longer-term, in a rising or in a falling market. You can see we have here this for stocks in a rising and a falling market. You can see there's a difference in between this, and it might be a difference in an election year or in a normal year or in a crisis year. There might be some changes, but the raw number you can easily read here. So 68, it's not 100% sure it's every year 68 or in every case 68, but you can see it's not 10%, it's not 20%, it's roughly at the higher end of that. So that's really important to understand how we will deal this in the future. So the good news, if you can see this in the beginning or that, both are impulsive moves. You remember the first three here, impulsive, leading, and ending diagonal. You can see all three are impulsive moves into the direction of the trend, and all the other one you can see here the short namings. ZZ is a zigzag, DZ is a double zigzag, and so on. You can compare by yourself if you want. You might stop the video sometimes and see some parts again if it's too fast, but I'm quite sure you will get into it. So the strong moves are the first three. The counter moves are the last one here. And you can see the first one, if this, and that's really important, if this is an impulse, is going in one like this. It's an impulse or leading. It's, of course, never corrective. We will have a look at the corrective patterns later. The second one, let's have a look. The second one, this was the second one. Okay, it was against the move. Okay, against the move. It is never something like this. Never. It is something like this. Maybe even like this sometimes, but not in this case. You can see there's a 0, 0, so no probability so that this occurs. This is by rule in this case. Elliott said, no, this is not possible in that case. And so, of course, the database does not have any. But you can see it is quite probable to have, let's say, this here. And we have some more probable and some less probable here in this case. So triple zigzags are really rare, and I don't want to talk about that so much because it's really easy to identify them. Whenever the chart is looking, we say, ugly or something, I don't know what this means. It might be something like this or like this, because it is really, I'm sorry, like this, the triple sideways. I'm really sorry. T3 is a triple sideways. So this is a little bit funny, but you can easily guess here from the order of the names here. So if it's looking ugly, if you say, I don't know what the market is meaning to us or saying to us, then it's most probably this one. But in any other case, we have something like this, which is also some kind of a sharp correction, or something like this, which is more a sideways correction. So let's stick with this one. You can see the second one, the second wave is never this one. The third is always this one. This is by rule. The fourth is a corrective one again, and the third, the fifth is also something like this. And this is awesome, because this means if we have realized the first wave, if we realize, this is looking like this. Okay, unfortunately, we have to wait until this end. We know after this, definitely it needs to be corrective. So if after this 5-wave move to the upside, an ABC to the downside is coming, there is a 100% chance we will have something like a 5-wave move into the upside direction. So if you can realize this in the future and understand this is the first wave, we have to talk about this later, but if you can realize this is the first wave, so the market is coming from upside, this is a clear low here, this is the first wave to the upside, this is the second, the corrective pattern to the downside. It is for sure that something similar like this will occur here. So you can trade this part and thinking of a strong moving to the upside. So is this in all cases? So let's check. If we see something here at the beginning, I would say after a break, we will continue into this direction with a strong move again. So let's check it out. How about the leading diagonals? First to the upside, second to the downside. Yeah, it will continue to the upside. It's not as strong as the impulses, but we are right concerning the direction. It is moving to the upside, so it's no problem at all. Let's check the endings. No, it's not a 5-wave to the upside. Okay, we can skip this. It's not working in this case. Let's check the zigzags. Yeah, they have also 1, 2, 3, 4, 5. We wait for the break, and after this, it will continue. And you can check this out with all of these patterns. I will skip this a little bit. There is none anymore, which is having something like a 5-wave move at the beginning. So it does not matter what's happening in the aftermath. It is not worth talking about this. Let's talk about flats, because flats are quite important. They are very many occurrences. Okay, no 5-wave move, we cannot use this. But whenever in the future you have a 5-wave move and a corrective pattern following, the first wave, second wave, you can guess the third wave definitely will come up into this direction. And this is from this structure. You can see it from this structure. This is working in, let's say 100%. So let's check this number plates here with the zigzags, the internal structure. Let's have a zigzag. The zigzag was the first one, an ABC to the downside, and followed by another impulsive move. How does it look? The first one is impulsive. The second is corrective. It's exactly the same like we have in an impulse with the second. We have a little bit different corrective distribution here. It is a little bit different numbers here, but it's exactly the same. The B wave cannot be impulsive, and the C wave is also impulsive. So we can, of course, see the chances are really high that the market will continue. So it's not absolutely important to understand at that point, do we have this picture or do we have this picture? It's not necessary. If we enter the market somewhere around here, the market will continue into the same direction. That's the most probable outcome. So that's something really, really important to understand how market works. If you can read this, if you understand this, you have a very, very big, you made a very, very big step into the right direction to understand what direction is coming next. So, what is it? It is the first move to the upside. The second, we just have to wait until the second wave is over, and then we can work for the third wave, which is going into the same direction. And this might be a small issue for some, in some cases, because we have to wait until this is over. Is there a bell? Do they call me? How do I get out? Do I get the information that this movement, the counter movement, is over? How do I know that? Is there a chance to do that? Yes, there is a chance. First of all, we need to see how the structure looks like. Typically, it is something like an ABC. So if you see something like an ABC, you have a good chance that this is a corrective pattern inside, and which is marking the B wave here in the market, which is really, really good, helping me to understand, okay, I'm here outside of this situation or inside the B wave. Okay, that's the good news. But how do I know, is it really over or not? And for that, we have something like these curves you might have seen in some other videos of me already. They are looking like this. So let me get into this a little bit and describe what this is meaning. First of all, in this case, we have something with the zigzags in the equity market. Short term is, in this case, not necessarily intraday. It could be for some days or even a few weeks maybe, but not on the really long run. And in this case, for the rising market, I'm normally only referring in my videos and my analysis with the rising price market, because there's not a big difference. Sometimes if it's really important, I switch, but if I switch here for the long term, for example, you can see it is more or less the same. It is a little bit shifting here, a little bit to the shorter end, but it's not really important. And you can see if it's falling prices, it's more or less the same. It looks a little bit different, but here's a peak. But I will tell you, the peaks are not really important. In this case, you can see there are no numbers here on this side. It's not about how high this is. We are talking about the area here. So we are talking about the area here is representing 100% probability. So everything below the curve is 100% probability. The red area here is 60% of the whole area. This is 20%, and this one is also 20%. So altogether, 20, 60, 20 is 100%. So we can see in a zigzag, the second wave, which is this one, this is the first, this is the second. The second wave, we can check for the length. In this case, we are talking about price. So how much does the market is going down in this case? How many points, how many dollars, or how many whatever currency you're using in your markets? How far does the market is going down? So you can see it is not very probable that it's only a 10% drop. You might say, yeah, but I have seen the market is only dropping 10% and then rising again. Yes, of course. But it might not be a zigzag. It might not be this wave you are talking about. Maybe you are talking about this wave or this wave. But we want to identify this wave and want to realize, when is it over? And for this, it's important to see, okay, if it's only a 10% drop, it is most probably not this one. So we have to wait for another drop going lower than 10%. If the market is going 20%, we can see, okay, the area left side of my arrow is still very small. The whole gray area here is 20%. I guess, I don't know exactly, and it's not 100% important how much it is exactly, but I guess this area here, it's quite high here, this is very low. I think this is 1/3 here, 2/3 here, 1/3 here. Let's say it is 14% or 15% or 13%, somewhere around this, that it is only a 20% drop. It is possible. We all know 15% is not very probable, but it is absolutely possible. This is something we really need to talk about in a few seconds. So it is the probability is higher that the low is not found already, so that the market will continue to the lower end. So we can see 25%, we have at least 20% probability. 30%, it is over 20%. And let's just say, roughly say 40, somewhere 40%, we have roughly half of all the probability. It is a little bit on the left-hand side here of the base, but on the other side, the area here is way higher than here. So if you have to cut this in half, the 30%, the 60% here, to cut this in half, I would guess, I'm not absolutely sure, it is roughly here. Of course, I could cut it out and I can try to measure this, or we can do some math with it. We all had this in school, but I think this is not really important whether this is here or here or here or here or here or here. Most important is it is somewhere around here. It is somewhere around the 40% or early in the 40% area here, where we have a half chance that we have seen the low. If you see a drop, we all know the Fibonacci's, for example, and if you see that this drop here is reaching the 50% level, just for an example, we know, the probability is high that we've seen our low already, because chances that the market will continue to the lower end and it is still a zigzag is not very high anymore. If we see 61.8%, for example, which is roughly here, we see, chances are nearly 75%, 80% that we've seen our low already. So that's the reason why many people are relying on the Fibonacci retracements, because they say, when the market is going into this area, it is most likely that we've seen our low again, or already, so that we can continue with the bull market and continue with buying the markets. And of course, this is the reason why I always use something like a trigger. Maybe you know already, I would enter the market at that point here to continue for the bull market, because this is also giving me an indication. But this is a little bit too much detail here for this video maybe. So the good news is I have an idea from the probability here. Is the counter trend, the corrective phase in the market, already over, or should I expect something more? And let's have a look at another one. I don't want to dig too deep and don't want to go to all these in this video. Of course, sometimes when I'm talking about the charts, I will pick up one of these graphs to show you what I'm thinking of, but I want you to understand how to read this one. But if we see, okay, maybe we have seen a first wave to the upside, 1, 2, 3, 4, 5. And now we had an ABC to the downside, structure is perfect, and this point is low enough to mark the end of the counter trend. And we want to think about how far will we continue to the upside. So we don't need to measure the second in this case, we have to compare the third wave maybe with the first wave. So in this case, we take this graph here, this one, because we can see the third wave compared to the first wave. And you can see in a zigzag pattern, all these numbers are only for zigzags in this case, we can see it is quite probable, the high potential that the third wave has roughly the same length than the first wave. It can be less, but it is really, really probable that it's 70% minimum. So that the third wave is only a little bit shorter than the first one. But it's even possible that the third wave is double as long. So we can see, okay, we should think about, the market has a good potential, but we should not bet. We should not say, I'm quite sure the market will, of course, go double as far or even more, 300% of the first wave. No. The probabilities are not too high for a zigzag. But we can think reaching the 100% target is quite reasonable, because the chances for that are really, really high. So that's the reason why we normally, if we have a really simple trade, enter a market position when entering at that point, and taking profits when we reach the same length here to the upside. So if you see something like the same here, the first to the upside, the second is down, it might be over, we enter the level here, and our target is the same length here to the another one. We will talk to this like a one-on-one target or the 100% projection target. This is something we most of the times we name when trading the third wave. The cool thing is, in this case, it does not matter whether we will get this one or this one, because the behavior and also even the numbers in this case for the setbacks are the same. And the good thing is also here 100% is quite probable. To be honest, there's even a chance to see more. That's awesome, but at the very beginning we don't know, will we get this one? After seeing this one, will we get this one and another one? Or only this one, getting this one, and then it's over. We don't know it at that point here. At least if you only see this one. Of course, if you have a combined Elliott wave analysis, you can think about, in the big picture, it is quite clear we will expect something like an impulsive move. But this is something for another video, of course. So let's go for the last numbers, and then I want to stop it here. I know it's really a lot of number crunching, but I think it's really important to understand what this all is about. Because if you can see the statistics behind that, it's way easier to understand how the market is moving. That's really, really awesome. And you can understand some of my videos better when I bring up all these charts with these areas here and talking about that. So that's the reason for this video. And we have another statistics also for the time, because this is only concerning how deep is the market going down or up in another case. And in this case, here we are talking about time. So in this case, we are comparing how long in days or minutes or months, depends on the time frame you are looking at, how long does it take for the second wave compared to the first wave, for example. You can see, okay, the first wave, for example, took 1 day. It is expected that the second wave might be a little bit shorter than 1 day. It might be only half a day, or something a little bit like in the middle of it to have the highest probabilities, maybe 60% or something like this. So you can understand, okay, it is too fast. For example, many people are thinking the market is dropping down really, really fast here. This is the complete correction. And it's not, because probability is higher, that it takes more time. This is something really, really important to understand. If you want to have the highest probabilities on your side, you take also time aspects into your accounts, because this is giving you a more or a higher probability that what you think the market is doing will really occur in the end. So in this case, time-wise, you can also compare, for example, the second wave to the first wave. You can compare the third wave to the first wave and any others, depending on how many waves a special pattern has. So I don't want to get or dig deeper here into all these things. You can, of course, think about that we have all these number crunchings and all these curves and different patterns here. Flat, you can see, is a little bit different. It's a completely different pattern. So of course the numbers here are looking different. I will talk about that when talking about the Elliott waves in general, or when I have one of my next current analysis about the market or talking about the markets. I will show you these pictures depending on what is most important in that case. So I don't want to encourage you to learn all these numbers and to learn all these exact details. It's too much of information. Of course, you will, step by step, we will learn it anyway. But I want to encourage you to understand the raw idea behind all these database and the raw idea how the market is moving. And it is not a guesswork. It is reading the probabilities, learning how to deal with them, and using them for your benefits. So if we know how high the probability it is, is in one case, or we have a high probability, we know we can trade this. If we can see our probabilities are quite low in this case, of course we could trade, but why should we? No, we are not doing, of course, because probabilities are not into our favor. So I hope this is helping you a little bit. I hope you had your fun out of it. And don't worry about not having these by your hands. I cannot give you the database as I told you at the beginning. I'm not allowed to do this. It's not my own property. But I can, of course, show this in many cases. You can, of course, take screenshots if you like. But I don't want to encourage you to learn all these numbers. It is to understand how it works. And when you see some of my videos, you know, you don't need to know all of these numbers. It is important to know this one, for example, to know this, and this one, for example, and this one. So we don't need to learn all of this. It's only to understand how it works and where the best points are. I will teach you in many videos. I will bring you many trading ideas on a big picture, sometimes on a small pictures on different platforms. Please stick here with the channel. If you like it, give a thumbs up, and don't forget to subscribe so that you don't miss the next video when talking about the markets or how we deal it. So have a good day, be successful in trading. Bye bye.